Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 1311A and today's date is June 20th, 2017, and the title of the episode is We Can Pretend All We Want. The U.S. is in a recession and heading for the big one. Let's get into the economic collapse financial news. Now, we've been looking at the economic sectors, and I'm just going to call it, let's not pretend anymore. The U.S. economy, the world economy, we've entered a recession. We've entered it a long time ago. Let's stop the pretending right now. Even though the U.S. government, the Fed, they're never going to admit that we're in a recession. They don't admit this until much later on. We are in a recession. We're headed towards the big one. And we can see by all the information that we've been looking at and following, we can see that everything that we've been saying has been coming true. Now, yes, it's been taking a very long time. They're very good at manipulating. Think about how long it took those individuals that were looking into the subprime securities back in 2005, 2006, and they found out what was going on, and they predicted, at the end of 2006, it would come down. In the beginning of 2007, it would come down. At the end of 2007, it would come down. And they really thought that, wow, this should have come down a long time ago. And it kept going on all the way to the end of 2008, 2009, to the beginning of 2009. We've been following all the economic information, and we realize that everything, everywhere, is falling apart. Now, we've been looking at retail numbers. And we've been saying, going way back, that retail was going to continually get worse and worse and worse as time went on. Even the holiday season was not going to do well. And we kept on saying that stores were going to close. We're going to see more stores close, more stores go bankrupt. And over time, this is exactly what has happened. Now, the reason why we said this was happening was not because of the weather, not because people didn't want to buy stuff, not because of online. We said people were being laid off. People didn't have work. The unemployment numbers were fake, phony. We knew that people were getting maybe 1, 2, 3 part-time jobs, and people didn't have the extra funds to go out and pay for all the goods in retail. And what we're seeing right now, and this is coming out of the Census Bureau, where they've looked at the sales of retail, and they looked at wages, and we can see that wages and sales, well, it looks like they're pretty much matching as things went through time. And as we look maybe back to 2008, we saw as wages started to drop, guess what happened? Retail sales started to drop. As wages started to move up, retail sales started to move up. We're at the point where wages are continually declining. We're seeing retail sales declining. And this is exactly what has happened throughout time. And as time goes forward here and more people lose their jobs, more people lose their jobs in retail, more people take part-time jobs, it's going to get worse and worse. And before you know it, we're at this period where people don't have any funds to spend in retail. This is why we see so many stores closing right now. People are not saying, hey, you know something, I don't want to spend money in brick and mortar stores. I'm just going to spend all my money in online sales. They're not doing that. That is a myth that was created by the corporate media. Same myth that they said people aren't shopping because it snowed, it rained, it was a little windy out today, the sun was too bright. They made every single excuse known to mankind that they could use, and it all didn't make sense. And we could see today, from what we've been looking at, it is because people aren't making the income. That's what is the problem. People don't have the high-paying jobs. And we've been mentioning pensions before. Companies are in trouble with pensions. And it looks like GE, well, they have the largest pension shortfall in the S&P 500. It's a $31 billion balance sheet hole that keeps growing. Now, what is happening here is that we're seeing company after company after company, municipality, city after city, where they have these huge holes in pensions. And they're not going to be able to support the pensions moving forward. In the last 2 years, GE spent a little more than $2 billion on total pension contributions, which hasn't been nearly enough to keep the overall shortfall from widening. It's getting worse. So GE needs to come up with nearly $5 billion a year for 10 years just to meet pension obligations. And this assumes an annualized rate of return of about 7.5% a year. I mean, warning bells are flashing here. Returns are far more likely to be zero or negative than anything approaching 7.5%. And the danger of default is real. And we see not just GE, but many other pension plans. They have the same exact problem. And it's going to be a complete disaster as we move forward. Now, Caterpillar, they have been seeing about 54 months of declining sales. And they hit rock bottom. This is a longer stretch of time than the Great Recession. And just in the last maybe 2 or 3 months, they'd had a little pop-up, a very tiny pop-up in the last 2 months. The third month, they had a pop-up, and they grew by maybe 1% or so. And what happened was, out in China, they decided to basically purchase a lot of equipment. Now, this is a one-off thing like we've seen before, just like the United States with the GDP right before the elections where we had this export of soybeans. Well, we've never seen that again, and GDP just crumbled after this. This is a one little pop-up, and believe me, this is not going to repair Caterpillar. Plus, Caterpillar has been closing plant after plant after plant, laying off thousands upon thousands of people, buying back their shares, and we can see right now that this will not be able to sustain Caterpillar whatsoever. Now, we're looking at all these bubbles in the market. We see the stock market bubble, we see the bond bubble, derivatives bubble, housing bubble, automobile bubble. We see bubbles all over the place. And coming out of Bank of America, David Wu asked if there's a different motive behind the Fed's tightening intentions. Namely, is the Fed trying to pop the market asset bubble? Of course they are. This is why they've been pushing the interest rates up very, very slowly. They want the bubbles to pop. And we can see already within the economy, things are starting to deteriorate very, very quickly. And I wouldn't be surprised if they raise it once more and everything just implodes. Now, they're doing it very slowly because they don't want to be blamed for what is about to happen. They're saying that they're raising the rates in a strong economy, saying that this is helping the economy. And SocGen's strategist Kit Juggs picks up where Wu left off. Whether the Fed is raising too fast, giving their inflation mandate, or not, they are raising them too slowly to contain asset price inflation. So they're already seeing it, and they're saying we have major problems here. Now, we talked about the global credit impulse, and UBS has some very bad news for the global economy, where they're showing that the global credit impulse is collapsing. And what does this mean? Well, Citi is out there telling us why it's so critical. So Matt King is explaining, and he's focusing on the one thing that is wrong with this recovery: the pervasive lack of global inflation, so desired by the central banks. Now, of course, we know they took the inflation and they shoved it off over to other countries. They put it into the stock market. They put it into the housing bubble. And this is how they moved inflation around. They're saying the inflation shortfall isn't new, and yet the current level of credit growth would traditionally have seen inflation above 5%. And while the central bank experiment had limited success in stimulating inflation, there was one obvious consequence: credit-fueled asset bubbles around the world. This is where the credit impulse comes into play. It allows market participants to track the instantaneous change in central banks' credit creation, and more importantly, the change in the flow of credit, which drives GDP growth. The impulse is also important as it directs investors' behavior as well due to its correlation with asset prices. Citi concludes, we've just had the biggest surge in the post-crisis era, and yet the central bankers' holy grail inflation remains low. So what happens when the credit impulse turns negative? Well, credit slows, it freezes, and we have a major disaster. If we look back to 2007, 2008, we had the exact same thing happen. Credit froze up. We're at that point where credit is going to freeze up and it's going to be a complete disaster. Now, we have been looking at many different indicators letting us know that this economy, well, it is in a deep recession right now, and we're heading to this major collapse scenario, which is going to be horrific. And we talked about the yield curve. And the difference in yield between treasuries due in 5 years and those maturing in 3 decades tumbled today as low as 96 basis points this morning, the narrowest since December of 2007. The last 2 times the U.S. yield curve was this flat, the U.S. economy officially entered a recession. And guess what? We are right there. The 5-year Treasury notes are among the most sensitive to the Fed policy outlook, but it appears the yield curve is not just falling for the Fed's growth hype pitch. And what we're seeing is that they're hiking the interest rates, and we see it decline. We see the yields decline. This has gone on throughout the year of 2016 into 2017. When we look, we can see that every time they increased the interest rates, the Fed rate, we see the yield continually drop. And we've seen this before, going back to 2007 to 2008. So everything that we're seeing right now, we have seen before. This is nothing new. It's not different this time. It's exactly the same. They're using the same exact formula to bring the economy down this time as they did back in 2007, 2008. And I'm sure they're predicting no recession. I'm sure they don't even see anything happening. There are no bubbles. It's the same exact excuses they've been using forever. They say the same things over and over and over, but we're looking past that. We're looking at exactly what they're doing. We're looking at their formula, and we can see exactly what they're doing. This is not going to be a small little recession. This is not going to be a depression. This is going to be a collapse like we've never seen before. Why? Because we never recovered. This will all come out later, like it always does. The economy never recovered from 2008. They just covered everything up. It's like a household where they're in so much debt, their income continually drops, and they take out a credit card for $50,000 and they say everything is fine. And that lasts for about 4 years until all of a sudden things start rapidly falling apart. And they don't have any more credit to get another credit card. Their income hasn't increased. They have a lot more debt, and everything starts to break down. And guess what they have to do? Well, they have to go bankrupt. This is what we're seeing in the economy right now. And when we hit that point where the entire system falls apart, everyone is going to realize what just happened. And for a lot of people, it's going to be too late. But for those people who've been preparing, you will be ready for what is about to happen. Think about all those people, if they knew what was going to happen in 2008, instead of riding these bubbles and thinking that everything was going to be great and adding on another house to their other 6 houses that they had, or thinking like, oh, I might lose my job. Maybe I should invest in gold and silver or put some cash away. Maybe I shouldn't purchase that expensive home. Think about it. Because last time it hit, 38% of the population. This time it's going to hit the rest. And this is why everyone needs to be ready and prepared for when this hits. Because it's not going to be something where you say, oh, all right, I lost my job, I'll just find another one. What's going to happen is you're going to lose your job, and everyone around you is going to lose their job. Which means everyone then will not be able to pay their mortgage or their rent, which means we're going to see a lot more real estate come onto the market, which means housing prices are going to fall. We're going to see stock market bubbles collapse. Retail is going to collapse like you've never seen before, because now people are definitely not going to go out and purchase. And this is going to be a domino effect. It's going to hit one sector after another before all the sectors are completely dead. And there's nothing else to do except restart the system. But they're not just going to say, hey, let's restart the system. They're going to tell you that everything's going to be fine. We're going to start stimulus up once again. Don't worry about it. And they're going to pretend that the economy's improving once again. And what they're going to end up doing is they're going to have this event. Why they are telling us that the economy is doing well, this event will hit. Most likely it'll be a cyber attack. It'll hit the financial institutions. And they'll say because of that, that's why the economy fell apart. Not because of what we did. We were trying to help it. Trump brought it down in the beginning. We brought it back up. But then we got hit by this event. And this is what they're going to try to convince us of as this collapse occurs. And you're going to hear a lot of talk about we didn't even see it coming. We had no idea. It must have been because of Trump's policies. I can't believe this is happening. Everything was fine with Obama. And they're going to make up all these stories. It's going to be floating around the corporate media. It's going to be like crazy. But the worst part of it is that the majority of the people around the country, they're going to be hurting. They won't be able to pay for their homes. They won't be able to pay for the electric, the gas, food. Credit's going to freeze up. Deliveries to stores are going to end. People are going to run to the market to try to get whatever they possibly can. We're going to see inflation in this country because all those dollars are going to float back to the United States because when the other countries realize, I'm not holding on to this currency. The whole system's collapsing. We don't want to hold on to this. We want to get rid of it as fast as possible. This is what happens. They're going to try to sell off treasuries. They're not going to want to hold on to this. And as it floats back to the United States, we're going to see the devaluation of the dollar. It's going to be a complete disaster. This is why you need to be ready and prepared for what is coming. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.